Now let's go to, I think, what everybody's probably most interested in. Are the banks, are they lending money? And first of all, I think you have to really recognize the fact, somebody said the other day, the Great Depression, when the Great Depression was occurring, nobody called it the Great Depression at that time. I think the time that we're going through now, years from now, they'll look back at this and call this the great era of deleveraging. There really is broad deleveraging, consumers, business, across the board. So the bad news about that for banks is why, now that we've kind of gone past the stage of can we raise capital, can we survive this, how do you generate revenue? How do you replace the real estate loans? How do you find ways to generate income? The government can't let you charge as much fee income. So really it's the revenue challenge is probably is most concerning to the banks. Bank credit, because of deleveraging and the scrutiny, contracting 15% a year. That's frightening. There's 1.3 trillion of cash, record levels of cash in the Federal Reserve. So banks are anxious to lend money. If you think about this, people think, well, you have no incentive to lend money. We have a lot of incentive. When you take deposits, you either lend money, you buy securities, or you deposit with the Fed. So loans are contracting. It's not smart to go in securities because of where the fixed income market is. So your choice is to take your excess money and put it with the Fed at 25 bips, 1/4%. You're paying FDA insurance between 20 and 40. If you're paying somebody half of a point at one point, you're losing money. We hit a peak last week. Our bank sold $2.5 billion of cash to the Fed, and so at a loss. So banks are lending money, but the enthusiasm to lend is really somewhat tempered by more restrictive underwriting, the OCC oversight. I mean, like it or not, the banks have got to prove that any loan they make today, you've got the documented cash flow to service the debt. It can't be based upon future market or deep equity. You've got to have the cash flow, and that's a common theme in every bank. Nobody's any different on that. This is an interesting chart because I think it speaks to the fact that banks have had to build the reserves. When you're really forced to look at your whole portfolio. So this chart shows it's not commercial real estate, but look at business banking. Small business loans at the banks, what they call problem loans, whether you're special mention, substandard, doubtful, 28% of business banking loans at all U.S. banks are considered problems. Now you're charging off maybe 2 to 3% of those, but 28% are classified. We have some of those that we said, this is a great borrower, it's going to be fine, but if they've lost money 2 or 3 quarters, you got to classify it, and you got to set up a 10 to 15% reserve. So that's the squeeze that the banks are in. So as these start improving, which you're seeing that they are, it frees you up to really kind of make more loans. TARP, I think this is another kind of a good sign, is $245 billion of TARP funds were distributed in 2009. Now there's been more repaid than outstanding. Not so much because the banks have made a lot of money, but the capital markets have said, most banks are going to survive, certainly the largest banks, so there's access to capital. You can go out and raise capital. So banks have gone out, they raise capital to bolster their reserves and also to repay TARP, which there's pros and cons to that because actually TARP money is relatively cheap compared to dilution of your shareholders. And this, I think, is another evidence of that. Total equity capital of all U.S. banks it's pretty doubled in the last 8 years, but now $1.3 trillion. So there's definitely capital in the banks. Last kind of category is, again, I think it's a time to be cautious. A lot of us here are the veterans of the 80s. And I think unlike the 80s, Houston really is, I think, much better positioned in relative terms to withstand the economic stress. Why is that? In the 80s, when energy dropped, prices were depressed for 7, 8 years. The energy sector shed over 500 jobs. The prices came back really in 6 months in energy. So a lot of our borrowers in the energy sector really rebounded very quickly. Only maybe 1,500 energy jobs contracted last year. So it's a whole different place. And this is more than I think just anecdotal. We see a very broad spectrum of the business community, and we've been impressed by how quickly a lot of our borrowers have responded to the challenge. They've sold down inventory, they've cut back, they returned back to profitability. So I think people have been smart about it. Similar to the 80s, though, if you said what's the big problem spot for the banks in this market, we know it's the case across the country, but commercial real estate, that's come back to, I think, to bite us again. It came late for us, it really was late in 2008, but that's what everybody's really kind of got to work through. And I think Tom makes a good point. It's an individual conversation every time. You can't really generalize about that. So at the end of the day, I think the recommendation and kind of takeaway thought is we've got to strive for a balance between caution about kind of where we are. We do have a lot more that's coming our way, but we also have to have the confidence to cut and to invest and to spend. For every one client we have that's in kind of the bank hospital, we've got 15 to 20 that are doing extremely well and looking for opportunities and buying. So we are lending money. We approved 3 private equity deals in the last month, but they've got to be really the right deal. You'd see all these economic charts. A lot of them can be artificially changed by the government printing money, but the one chart I thought was really interesting, if you look at money velocity, the rate to where money changes, whether it's business spending or consumers, that really cannot, that number or stat cannot be influenced by the government. It really is. And it actually got to all-time high because Wall Street created all these new financial instruments that allowed money velocity to increase even more, the subprime and what have you. So if you look at this chart here, it's really interesting. The velocity of money hit an all-time high, over 2-time velocity. If you look at where we are now, we're getting into the danger zone. The last time velocity of money dropped to 115, 117 was during the time of the Great Depression. So the good news is I got an updated chart of that yesterday. This has actually started to improve a little bit, but it's imperative for the private sector to regain some confidence and invest and spend, because that's going to prevent the government from having to print more dollars, inflation. So it really is smart to do that, to really think about the investment rate at which the private sector needs to do that. And I know Obama, everybody's anti-Obama, will probably have a change certainly in November, but I think that's going to be the ultimate remedy to get back to a good economy. That's it.